Hey, what's up, everybody? Shout out to you and the dozens and dozens of people all across the country tuning in. I appreciate you being here. You have heard me talk about all the different types of accounts that we have. We have taxable accounts, joint and individual. We have pre-tax accounts like traditional IRA, traditional 401k, and then we have after-tax accounts like a Roth IRA or a Roth 401k. So after-tax, pre-tax, and then taxable different accounts. And you've also heard me talk about and write about in my books that my favorite account out of all of those is actually the HSA, the Health Savings Account. And here's why I like them so much. You do have to be on a high deductible health insurance plan, and that does not make sense for everyone, but if it makes sense for you and your family, you go on the high deductible health insurance plan, you're eligible for an HSA. You can put, I forget the exact limits, but it's like $3,500 per individual times 2 if you're married, so like $7,000-ish that you can contribute to the HSA. When you put money in, it lowers your taxable income in the current year. It grows tax deferred, and then when you take it out for a qualified medical expense after the age of 65, you get a tax-free distribution. So it's a triple tax benefit. You're never paying tax on that money if you use it the way that I just described. And so it's a really amazing account type, and that's why I love it so much. And it offers just so much flexibility because you're going to have health expenses at some point after 65. And so it just gives you opportunities to use it during that period and really get some nice tax advantages there. However, what I have not talked about is what happens if you pass on your HSA to someone who is not your spouse. Now, if you die before your spouse dies and you have an HSA and your husband or wife or whoever is the spousal beneficiary, then that spouse gets the HSA as their own HSA. So they don't lose any of the benefits and they just get to carry on with it. So that's all good. That is gravy. What is not gravy is if you pass on your HSA to someone who is not your spouse, like a child. Because once, if a parent passes on the HSA to a child, the HSA actually loses all of the tax benefits. And that HSA account basically turns into a taxable investment account. And also, let's say we've got, a certain amount of money in that HSA passes on to the kid. That's taxable income to that kid. Whatever dollar amounts that is in the HSA that's passed on to the kid, it's taxable income in the year that you pass away. So that's actually not that great. So I just want to run some quick comparisons on if a parent dies and they've got $50,000 in a Roth IRA and they've got $50,000 in an HSA, what do the numbers look like for the kid? So $50,000 in each with the Roth IRA, that kid inherits all $50,000 tax-free. Nice and simple. They do have to take it out within 10 years. That's a relatively new rule in the last 2 to 3 years. So that kind of stinks, but they get all of that money tax-free. So that's wonderful. The HSA, though, again, and let's assume that the child is making $50,000, and let's also assume they're living in California. So $50,000 they receive, and they're already earning $50,000. So it knocks their ordinary income up to $100,000. So it pushes them into a much higher tax bracket. And then they also have to pay California's 9.3% state tax on that HSA inheritance. So basically the tax bill going from $50,000 of income to $100,000 of income means that the tax bill is $15,000 to $16,000, depending on which calculations you use. So basically, that $50,000 in the HSA becomes around $34,500 of inheritance after taxes. So the smart move on my end is, and it's so hard to time it because we don't know when we're going to die, but the smart move is for you or your spouse to use the HSA proceeds before you pass away, and then that might defer you touching the Roth IRA for a little bit, and then when you both pass away, the Roth IRAs go to the kids. They get the money tax-free. The HSA is depleted. It's basically at nothing. They don't have to worry about getting inheritance with the HSA knocking them up to a different tax bracket. So that's all I've got for today. Just something for you to think about. If we can, between 65 and when you pass away, let's use that HSA. Let's use those proceeds. Any money that you want going to your kids, let's see if we can get it coming from the Roth IRAs. All right, hope this helps. Let me know if you have any questions. I'll see you next time. Bye.